It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And here's the guy, the most talked about man in the room. Everybody wants to be like Mike. Where's Mikey? Mr. Michael Becker, how are you?
Hey, Paul, doing well. What's new in Old Capital land today?
Oh, we're just closing loans left and right. As you know, we've been doing apartment lending for almost 35 years. And so I think we're pretty good at doing that. And so we've had a lot of transactions closed, getting towards the end of this first quarter. We had a good last quarter of 2020. I think we're going to continue to do very well when the numbers finally hit the books for the first quarter of 2021. So
I'm seeing a bunch of the deals you're closing. You guys going all over the nation too, right? You got a bunch of volume. I know we do a lot of business in Texas, but it seems like your share kind of across the country is really picking up quite a bit.
Closing loans in Florida, Georgia, Louisiana, of all places, Oklahoma, of course, kind of working our way towards Colorado, Arizona, up to Chicago, Indiana. So we're a national lender. So if everybody wants to get any good information about what's going on in lending, we do have a kind of a perspective because we do lend throughout the country. So thanks for bringing that up, Michael. That's very kind of you.
No, I just been seeing the deal sheet, and then all of a sudden all these cities I don't normally see on the deal sheet are popping up more and more and more. And it seems like you got the guys out there knocking on doors and taking deals down. We
are out and about. So as you know, Michael Becker, who has closed more than 10, am I saying that right? 10,000 apartment units for the last number of years. He is an operator of large multifamily properties. Before that, he was a large bank commercial loan officer. And so he was a loaner of money. Now he's an owner of real estate. So we asked Mike these great questions about what's going on with the economy, how you should be running your properties, what some people that maybe have just gotten into multifamily, what they should know. And so you want to talk with the most experienced person in the room, and that's certainly Mr. Michael Becker. So, Michael, thanks for hanging out with us. One thing I do want to mention before we ask the question for this week is don't forget, if you think we bring value to the conversation, go back to iTunes and leave us a 5-star report. We're trying to get 1,000 5-star ratings for this year. And so we certainly do appreciate if you do have a chance to go back and give us a 5-star review and maybe some words or comments that you thought were valuable or some critiques. We certainly do appreciate the good words or any words. So thank you very much. Again, look for a 17-page white paper report on the oldcapitalpodcast.com, oldcapitalpodcast.com that you can download. And what I like about that 17-page white paper report, it's just words of wisdom. If you've never owned a multifamily property and you've only owned a single-family home, it gives you kind of a perspective of what the lender should be seeing from your request. And so I think it goes into great detail. Michael Becker, James Eng, and myself wrote it. We continue to update it. So it's a great piece of information that I think you should continue to read and update. Second part of that.
Speaker series coming up again too, Paul. I know that's kind of kicked back off.
Yeah, the speaker series is kicked off. But the last thing I was going to leave with the 17-page white report is that you get Michael's due diligence checklist, that due diligence checklist. So if you were ever thinking about buying a multifamily property, you don't know what you should be asking the seller for, all the data that they should be providing you as a seller. Michael does a great job of breaking it down. Do me a favor, take his name off that paper and put your name on there, because Michael does not want to own a property in XYZ city. So, but it's his due diligence checklist. I think he does a great job. And as Michael said, we're continuing on with the virtual speaker series, and I think we're going to have some good news coming up here shortly with everybody getting their vaccinations, that we're going to be going back to our in-person conferences and our speaker series, where we usually have the conferences. We have 700-800 people. In the speaker series, we have 300 or 400 people come in, and we bring a speaker, and we all kind of network, and we have a great time. So that's coming up shortly. We'll look forward to seeing that. In the speaker series this for March is always a good one, and go to Old Capital Podcast and get an RSVP for that. So certainly do appreciate that. All right, Michael, here's the question. Michael, what is an ACHECK and how is that going to impact me in the future?
Well, yeah. So the ACHECK list is specific to Fannie Mae. So Fannie Mae has kind of their no-fly list or the bad boy list, and so people that went with these Fannie Mae lenders are all DUS lenders, DUS, delegated underwriter servicers. And as part of the loan process, when you apply for a loan, they have to run you through the internal system at Fannie Mae. And if you get on the ACHECK, that means they can't give you a loan. So you got to then call into Fannie Mae and kind of figure out what's going on. So they run it both at the beginning when they're issuing an application. They also run it right at approval, right, Paul? Like kind of at the end as well. So so you get kind of checked on twice when you're doing a transaction. And you get on that list for a variety of reasons. If you obviously don't pay your mortgage back, or these lenders will go through your assets on an annual basis and do a physical inspection. So if you have a bunch of deferred maintenance, or you're not taking care of the asset, or reporting your financials in timely, those are easy ways to get on the ACHECK list. So that is kind of the traditional way. And then I think something that Paul and I were talking about here recently. Paul, you've noticed a lot more people kind of popping up on the ACHECK list kind of than historically. So it kind of seems like Fannie Mae is getting a little bit more nervous about some of the newer market participants in the multifamily space, and maybe growing a little too fast, or doing a bunch of deals without a whole bunch of money in, kind of the gun for hire concepts on some of these KPs. What are some of the common themes that you've seen here lately? Because I know we had that conversation here recently about this becoming a little bit more of a problem that we never really saw in the past, and now we're starting to see it a little bit.
Yeah, ACHECK is a serious thing. It's not something to just to skip over. And a lot of people that are borrowers really do not know anything about ACHECK, and it's like an administrative check for Fannie Mae. It's almost like a credit report that they pull on you internally with Fannie Mae as an example. And Freddie Mac has the same type of system though too. So what it is think of going to see St. Peter up in heaven. If St. Peter has that big book and how you've been doing in your life, and there's three ways of going when you see St. Peter, and you can go to heaven. Or you can, if you're not that good of a boy or a girl, you can go, because I'm a Catholic, you can go to purgatory, which is kind of you can go either way to heaven or hell. It's kind of a holding place. And then the last place is hell. And hell is not a good thing to be into any which way you cut it. But hell for Fannie Mae, as an example, is that in the big picture things, is that if Fannie Mae were to make you a loan and that loan were to go bad for some reason, whether it's your fault or not, whether it was the economy or something were to happen, that Fannie Mae felt that you were not a good operator or you lost money for Fannie Mae, and let's say you lost $500,000 or $5 million and you're never going to pay them back, they're going to put you in hell, and which means that you're never going to really become a borrower with Fannie Mae in the future. So that's not good. And then purgatory, which is kind of between heaven and hell, is kind of a holding place. That's where you can go until they can get more information about what's going on. But what that typically is going to do is going to stop you from proceeding forward with doing any more additional business with Fannie Mae until they can figure out what needs to be done, what you need to cure on your property, whether it's the financials of the property itself or just common maintenance items that you've neglected. One of the things that we're seeing quite often now is for Fannie Mae to make unannounced stops at your property, take pictures of the property, see the condition of the asset, and they're wanting to make sure the property continues to be maintained in the best position. Fannie Mae does not really care about what you're giving away as a return to your investors. Their big pitch is that we are supporting the American tenants. We are mission rich for kind of affordable housing and making sure that we continue to offer the best product for the tenants on these properties, and we don't want you to, not keep up the property in its best condition ever. So be very careful, because if they stop by your property and they see an amount of deferred maintenance of $15,000, $20,000 or $100,000, they'll write it up and they'll send it over to your servicer and they'll put you on this ACHECK, which means that you can't, if you're a syndicator and this is your business going forward, it's going to put you into a box that you cannot do any more business with Fannie Mae. So now there's a kind of a wall between Fannie Mae and Freddie Mac that if you can't do business with Fannie, maybe you go over to Freddie. Can't do business with Freddie, you can go over to Fannie. Just be very careful because word gets around on that type of stuff that you're ACHECKed over here, but you go that route. People are going to ask about, why didn't you get a quote from Fannie? It's because I'm on the ACHECK and they wouldn't allow me to do any more business. So again, stay in heaven if you can. If you're a syndicator, continue to keep that property up the best. And I will tell you there, what we see, there's a lot of people out there on the education mentoring business that I think they do a good job getting people into properties. But one of the things that they lack, and there's only one or two of them that actually do this, they support their owners after the transaction close. And that's something that if you're in the educational mentoring group, you really want to have the support to understand not just what it's like to make a loan, but actually maintain the property after it's closed. And so, they'll teach you some of the things that Fannie Mae and Freddie Mac will have on their radar that you should be doing correctly. If you've never owned a multifamily property, if you've never been in a mentoring club, you really want to have some of these great mentoring clubs. And if you give us a call, we can kind of give you some insights of, if you do buy a property, you want to get them to help you support you after the loan closes, so you don't find yourself on the ACHECK that puts you in a box that you cannot continue your career. If in syndication, if you left your IT job, or you left your high technical job, or you left being an attorney to retire 5 years or less, so to speak, and you find yourself on the ACHECK list, you'll be going back to that job very soon, because it's going to be difficult for you to become a syndicator, to get non-recourse, long-term, permanent lending at low rates, if you find yourself, unfortunately, on the ACHECK list. Michael, any more comments or words of wisdom?
No, yeah, I think that's, you want to be a professional in this business, you need to make sure you maintain your buildings. Your lender is going to check on you, and make sure you report and communicate with your lender, and follow up for questions they might have, post-closing, all those things, or ways to get yourself on the ACHECK. And then be careful who you associate with as well. Since if you're on a deal and you got a bad, you're signing as a KP, the non-recourse loan, thinking there's no risk. If you get on a deal with an operator that's not doing what they're supposed to be doing, then all of a sudden you're guilty by association, and then that really impairs your ability to operate. So seeing that kind of the gun for hire kind of mentality out there, where you'll join on as a KP, maybe get a little tiny slice of the sponsor compensation to do so, to help them kind of get the deal done, and get hooked up with the wrong guy, and boom, you're out of business, right? So that's why we've never chosen to do that personally, because if you get on that list, it's hard to get off, and that'd really mess up our business model if I can't go out and get agency financing. So just be careful who you associate with, because that could definitely come back and bite you.
Yeah, if you always believe my analysis or my analogy of having you in the cockpit of an airplane, you get all the passengers in the back, those are limited partners. In the front of the cockpit, the guy flying the airplane who's the captain, who's the decision maker, and the captain is asking you to come on into the flight crew, becoming the first officer, and there may be 3 or 4 first officers, and you're going in there maybe to get some experience. Well, if the captain convinces you successfully to sign on that loan, but if you don't have any control of the transaction, true control of the transaction, and he may have a problem in the future of maintaining the property, having not being able to, if there's a cash call needed to these properties and you cannot bring the money in to cure the problem, that airplane may be going down in flames, and you're going to be part of it. And so be very careful who you associate, like Michael says, as an operator in the property. If you're willing to sign on his transaction, hopefully you get some control of how the property and the transaction works. Because that's one thing with Fannie and Freddie is they really want you, if you're going to be in the control structure of the managing membership group, they want you to be part of the solution team. I mean, a true member of the solution team. And they want to make sure that you're also walking or driving that property and seeing what's going on. They don't want you to be an absentee landlord, an absentee KP. They want to see that you're acknowledged about what's going on, because at some period of time, you're going to get a knock on the door from Fannie Mae. They're going to ask you a series of questions about, well, do you know what's going on? You signed your name to this. Do you know, have you seen when's the last time you sat down with management? When's the last time you talked with the management company? Who manages the property? What kind of relationship you have with that? And you're like, well, that's what the managing member should be doing. No, That's what you should also be part of that team too. So Fannie Mae, again, they don't care what you're giving back to your investors in rates of return. They're more concerned about maintaining that property. They're the largest partner you have in that deal. Make sure that they kept happy, and then you can stay in heaven. Anything more, Michael, on that?
No, I think that covers it, I think. So yes, be careful if you want to be in the business. Your reputation will precede you in a lot of ways, and making sure you guard it is of utmost importance if you want to be able to be a material player in this business.
All right, two things, Michael. One, what does SPI do? And again, what does SPI stand for? And tell us a little bit more about what your group does.
Yeah, SPI Advisory is the company I run, Strategic Property Investments, the acronym, and we've been in business for, about the better part of a decade now, Paul, coming up on a little bit over 8 years. It's been crazy. It's been that long since I've been owning large-scale multifamily in Texas. Sometimes it feels like 10 minutes, and sometimes it feels like 100 years. So it's been a good run. So what we primarily focus on, Paul, is putting together high-quality investment opportunities in the Texas markets and putting them out to go raise capital from a limited investor pool that we have. So if you guys are interested about getting into our database, learning more information about what we do, just simply go to our website, which is www.spiadvisory.com. It's SPI like spy, advisory.com. Fill the contact us form out. We're happy to send out information about potentially investing with us. We put a deal out in the first quarter, Paul, so got real excited. I think we bought 2 good opportunities and two A- deals in suburban Dallas-Fort Worth that what I think are hell of a good buys, and got, I think 8 or 10 of the brokers in town invest alongside of us. So that's always good affirmation when we're getting the guys that sell this stuff to put their actual cash in our deals. So feel pretty good about those. I think we got some good opportunities on the horizon as well. We're looking at a bunch of good opportunities, both Dallas-Fort Worth and Austin, which are the markets that we've been in, and thinking about going to San Antonio, and kind of I think it's a good time to enter the market, especially in the kind of 8A- space down there. Recently was do a lot of business in Austin, San Antonio with one of the top brokers down there, Pat Jones, and just was recently talking with him, and gets you all pumped up when you talk with those guys.
So that's part 2. Is tell me a little bit about what's going on down in Austin. I mean, you just recently had a conversation with Pat Jones with Newmark, one of the top producers in the country, really based out of Austin, Texas. What's his takeaway right now? Just I don't want to give away the episode because we're just about to play it, but what's on a high level? What were some of the things that you took away?
Yeah, so I interviewed Pat Jones for the complimentary show I've been doing to the Old Capital podcast, the multifamily investing show with Michael Becker. So we'll replay that episode here in a moment or so. But Pat is, like you said, one of the top investment sales brokers in Central Texas. So his office really covers San Antonio, Austin, and kind of everything in between on the I-35 corridor. And as everyone listening to the show probably knows, we my company focus on Dallas-Fort Worth and Austin, and looking to expand down 35 into San Antonio because we think it's a pretty good time. And kind of talk about the cap rates, what's going on in the various markets. Paul, it seems like with the interest rates being so low and the continued economic migration that's kind of been accelerated in the last year with the lockdowns and the government reaction to COVID, kind of shifting from the high-priced coastal markets into the Sun Belt and, Dallas-Fort Worth and Austin, and all of Texas really has been beneficiaries of it. So we've seen cap rates compression quite a bit, and Austin's got to be right up there, if not number 1, number 2, and probably the hottest markets, probably neck and neck with Phoenix and the entire country right now. Cap rates have compressed. It's big corporate relocations in the tech business been coming. Seemingly every other week you're seeing big announcements. So through this, we kind of talked about the boomtown that is Austin, and then kind of compare and contrast Austin and San Antonio. And I think one little tidbit that Pat dropped, that he's been in the market a long time. That in his entire career in investment sales, this is the widest spread he's seen in cap rates between Austin and San Antonio ever in his entire career. So, my observation is probably almost a full percentage point higher in cap rates in San Antonio right now, Paul, than is in Austin. And that's, usually it's probably closer to 50 basis points or inside of that. And right now it's probably a full percentage point I mean, Austin is absolutely the entire world's darling. Everyone wants to own a multifamily deal in Austin, and seems like which is great because we own it and we want to own more, and really bullish about Austin. But San Antonio seems like it might be a decent time to enter. Our conversation really was kind of comparing, contrasting the two markets and all the economic drivers. So if you guys are interested in Central Texas markets, this is a good interview to listen to.
That's great. So, Michael, thanks for joining us again today. Let's get over to your interview with Pat Jones and Newmark. And everybody that's listening, have a great day.
Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker, and today I'm happy to have my friend Pat Jones in from Austin. Pat, appreciate you joining us today.
Thank you.
Pat came in recording this on a cold, icy day here in Texas. It looks like winter's finally gotten to us. It's been a pretty mild winter so far. Pat is the vice chairman of Newmark. He heads the Central Texas office for the multifamily investment sales team. Pat sells about as much multifamily product in San Antonio and Austin as pretty much anybody. So I've done a couple transactions with Pat. So appreciate you taking the 3-hour drive up here to talk to us today.
Happy to be here. Thank you, Michael.
Yeah, maybe give a little brief background on yourself. How long you been in the multifamily business? What did you do before that? You didn't come like a lot of us right out of college into the industry. You kind of meandered a little bit before you got here.
That is correct. So I graduated from the University of Texas, and then it was always entrepreneurial and sales. So I was fortunate to have a job where I lived in London and Hong Kong, and the common theme was sales. When I got back to Texas and started kind of my second life, second career, I joined Apartment Realty Advisors in Houston, and boutique investment sales firm focused strictly on multifamily. That was later acquired by Newmark Knight Frank in 2015. Newmark's publicly traded. Yep. Our day-to-day is the same. We're strictly focused on multifamily. We actually started the Austin entity in 2005, and so I moved from Houston to Austin, started it from scratch, and we grew that business to about $2 billion in sales today. We do about 45 transactions a year. We sell ABC product, and our territory is Central Texas.
So that's San Antonio, Austin, in between, generally speaking?
That's it. The I-35 corridor, San Antonio to Austin, and everything in between, Kyle, Buda, San Marcos, New Braunfels, and those communities, as you know, because you own there, are booming. So what's
the, I kind of want to go through a couple things. So what did Austin look like? What did your sales look like? You came in the market in 2005. What was kind of Austin look like in 2005? Kind of went through the Great Recession, bottomed out, and then now it's been kind of boom time for the last decade, really. What did it look like 15, 16 years ago when you were kind of coming into Austin selling their first deals?
Sure. So Austin and San Antonio were always treated as a secondary market. Houston and Dallas were the huge business hubs, and what you would have is firms, commercial real estate firms, doing a few transactions a year in Austin and San Antonio. But it was always kind of a secondary act. So our thought process was someone needs to move there, focus, because when you look at both Austin and San Antonio, it's a huge metroplex. Yeah. And so our thought process was start, focus, and get to know all the owners. And then, of course, in the institutional space, all the owners were common. Yeah. And with the University of Texas being based in Austin, it always had that institutional appeal. Yeah. So we started at literally $300-400 million a year of multifamily sales, grew that to about $2 billion in sales. A lot of that was a gift of the market. As multifamily just matured and institutions applied more capital to multifamily, it was natural that they would start looking at these fast-growing cities with a lot of millennials. A lot of college towns are popular for that reason, because you have young, educated talent, workforce. And so we kind of grew along with Austin. When the Newmark transaction happened, that's 2015. We've tripled in size since 2015 by adding a capital markets group, by growing our platform. But the concept's still the same. We've been riding this freaking amazing wave of Central Texas.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
The two different markets, very distinct markets that you participate in, but what did an average kind of workforce housing or maybe, a new construction deal, what kind of price per unit did that stuff trade at then? And then where kind of are we today? And I know it's different per the two different markets you're in.
It's been pretty dramatic. So if you go back, kind of 04, 05, we would trade B-class deals, 80s vintage at 55 a door, maybe even 45 a door. A suburban Class A property would be 75 a door, would be a big number. And ironically, we didn't really have any mid-rises in Austin yet. We certainly didn't have any high-rises that were residential. Fast forward to today, the market has dramatically changed. High-rises sell for over $600,000 a unit. Mid-rises sell for over $300,000 a unit. And now recently we've had suburban garden Class A crest over $200,000 a unit. And the older urban infill 80s vintage would be more like $155 a unit. So from 45 to 50 a unit to 155 a unit in that space.
And what is that in San Antonio? Because that's awesome. San Antonio is a little sleepier.
Yeah, San Antonio, first of all, it trades at a discount to Austin, almost 50 to 75 basis points in cap rate differential. Austin is more dominated by institutional investors and private family offices. San Antonio it's more prevalent to see private investors, syndicators, private funds, and they're seeking the better returns. But they love the ingredients in the city for investment purposes, and but the rents aren't as high as Austin. And so subsequently, everything I just said about Austin, you kind of discount that a little. So for instance, Class A mid-rise selling for $200 to $215 a door today. They didn't have mid-rises previously. Sure. But let's say a B-class deal, 35 to 45 a door years ago. Now you're seeing those crest 100 a door in San Antonio.
Yeah, and that would be, like you said, 140, 150 a door in Austin. So maybe,
That's right.
almost 40, 50% higher on a per unit pricing. But the rents are probably $300, $300 higher in Austin than San Antonio for that same type of product?
Absolutely correct. A quick case study. We have a client that built a mid-rise in East Austin and a mid-rise on Broadway, a great location in San Antonio. Same product, exactly. Yep. In Austin, it sold for roughly $300,000 a door. In San Antonio, roughly $175,000 per unit.
Yeah.
So dramatic difference in the rental rates, but same product.
What's so what's the difference? I mean, a lot of people probably come to you from out of town. What's the difference between those two different markets? Like, what are the economic drivers, and why is Austin so much more dynamic or higher priced than the San Antonio market right now?
So Austin benefits from tech, and of course, being the home of the University of Texas. As far as the tech world, we've never seen corporate announcements like we're seeing now, which, of course, everyone's heard about. Tesla, Amazon has a huge presence. Facebook has a huge presence. You've got Apple building their 130-acre campus, which is addition to the existing campus. And then you have a ton of tech companies that most of us have never heard of, but they're sizable companies coming to Austin. That has driven the institutions to love Austin. When the institutions research group looks at Austin, they see high incomes, educated workforce, relatively affordable living, like compared to California and Silicon Valley. San Antonio, a more diversified economy. You have a huge South Texas Medical Center. You have the USAA massive campus there next to the medical center. You have UTSA, which is now roughly 30,000 students. And so just a more diversified economy, a slower growing economy. People always say that, Austin's more like a Ferrari, and San Antonio's like a Toyota Camry.
Yep.
It's a value play. It's a value play, and Austin has really peaks and valleys.
Sure.
San Antonio is steady Eddie, and that works for a whole lot of investors that are seeking yield and want a more steady ride.
Right. And so then my observation, we've only owned in Austin and Dallas-Fort Worth. We haven't gone to San Antonio, and I think it might be a reasonable time. We're kind of considering going to San Antonio. I know we've talked a lot about that offline here, and it seems to me that over the last, really kind of from 2014, 2015 all the way up until through 2020, both markets have seen quite a bit of supply. And then now, kind of as we're in 2021, Austin supply seems to be accelerating as we're having all these corporate reloads and the population immigration. I'm sure your day-to-day driving around Austin's terrible now because there's more and more people. And San Antonio's supply seemingly has pulled back quite a bit relative to kind of the apartment base, because both markets are pretty comparable, both in population as well as number of apartment units, because they're roughly 200,000, maybe a little bit over, and market rate apartment units in each market. But Austin has approaching 20,000 units under construction right now, and San Antonio's between 5,000 and 6,000. Maybe talk through that and kind of what you're seeing right now from a new supply standpoint.
Sure, and it's a great point, because all these investors that call us, they already know the good news. They want to talk about supply relative to their submarket because they've read in all these third-party media rating agencies that supply is the concern. And so if you look at the last 3 years in Austin and San Antonio, I'll start with Austin. You had almost anywhere from 15 to 20,000 units under construction at any one time. But all that meant was they delivered about half that number of units in a calendar year. So maybe 9 to 10,000 units will deliver in a year. Well, absorption exceeded supply in Austin the last 3 years. The in-migration was so healthy and the employment growth that the apartment developers were barely keeping up. Today, Austin's probably one of the hottest markets in the country. There's a lot of places you can't build.
Yeah.
We're once again concerned about supply, but not so concerned. I mean, the immigration is so robust and the corporate announcements have been so robust just in the last 90 days that they better build some apartments because the people are coming. So I expect Austin to just be in equilibrium for years. That looks to be the case. San Antonio is a different animal. When they had a supply burst, go back 3 years ago, they don't recover as fast as Austin, or they did not stay in lockstep. Okay. So supply got a little bit ahead of absorption, brought some concession into the market. And we would talk to owners who would say, everything's fine, but my operations are a little soft. My rent growth's not very strong. It's flat. And so you're seeing a supply pullback in San Antonio. I think it'll be very healthy for the market. But we have developers calling from all over the country, very excited about Austin.
Sure.
Equity is very excited about Austin. We're not getting that excitement about San Antonio. So again, it's probably really good for existing fundamentals, but there is a pullback in San Antonio on the supply.
And that supply within San Antonio was generally concentrated at 2 or 3 submarkets as well, where Austin's kind of spread everywhere. Everywhere you go, there's some sticks going up everywhere you look, or a crane in downtown putting the next $3-4 a rent high rise up in up South Congress or wherever. So it seems like if you go into some of those places like over by the Rim or up in North 281 and some of those little markets, that you probably actually have a chance to see some decent rental rate growth for maybe 21, 22, 23 before these developers get greedy again and start throwing a bunch more supply up. At least that's kind of what it seems to me.
Yeah, so great point again that Austin's done a great job of diversification, because you have 2 downtowns. That's the CBD and Domain Arboretum. So you've got mid-rises, high-rises popping up in these locations. Then you have some really strong suburban communities, Leander, Cedar Park, Round Rock, Pflugerville. Then you have the booming I-35 corridor, where you literally have thousands of units about 7 miles south of Austin. That's primarily because you could zone them there.
Sure.
And those are all good pockets.
Yeah.
And they serve different groups of people. In San Antonio, Stone Oak got a healthy supply slug. I-10 and 1604, which is Rim, La Cantera, a big supply slug. Westover Hills, not as much, but got a supply slug. And then along Broadway and Southtown, very popular mid-rise market. And like I mentioned earlier, it's just slower to absorbed, slower to recover than what we were seeing in Austin.
Yeah. So here we are in the first quarter of 2021 as recorded. We had a pretty tumultuous year last year where we had a really good start to the year. I know personally we had we made our entire year in the first 2 months, and then we went and hibernated for about 3 or 4 months, and then kind of started slowly coming on, and then it was a pretty strong fourth quarter. That's what it kind of seemed like from my observation of Austin. It was kind of cap rates were relatively stable throughout the year. There wasn't a whole lot of transactions in the middle of the year. Some of these deals that were going to trade fell out. Then a lot of them got re-racked in the fourth quarter and kind of cleared out towards the end of 2020. And it seems like obviously we keep talking about all these corporate reloads and these high profile expansions of the Facebooks and Apples and things like that. And I know Pat sold us a deal a few years ago in North Austin, and then the Apple campus is a few miles away, and then now it looks like Samsung, which is 3 football fields away from our property, looks like they're going to probably announce $10+ billion expansion to their chip facility. So what is kind of like the current state of the market as contemporarily as we talk right now? Is there like a deal story or two? Maybe talk through maybe some of the workforce housing and maybe some of the newer stuff, because I know downtown seems to be a little bit soft with all kind of the lockdowns, and the suburban stuff seems to be on fire. And that seems to be a little bit different than, say, in Dallas, where we have a lot of stuff, because I go to dinner in both places. In Austin, there's barely anyone out, and you go out to dinner in Dallas, and you can't hardly get a table at a nice restaurant. So maybe, do you have a deal story or two in the recent past of kind of what's going on in the marketplace?
Sure. So I'll start with the macro, and that is a soft urban market and a strong suburban market. And frankly, we're seeing that around the country in a lot of cities. But Austin took it on the chin especially hard because short-term rentals were especially prevalent in Austin because of all the tourist attraction and business attractions, conferences, festivals, football games. And so 10 to 20% of most rent rolls in and around the CBD were master leased to short-term rentals. During the lockdown, those went to zero. It threw a few hundred units on the market overnight. We were already in heavy delivery mode from new supply, so it just exacerbated the problem. 2 months of concession kind of overnight.
Yeah, and you're exactly right, because I travel to Austin all the time, and to get a hotel room, it'd be a hit or miss. It'd be, say, a nice hotel would be $150 one day, and then be $500 the next day, and it was kind of hit or miss depending on what's going on in town.
Exactly, and so soft urban market. Suburban, just the opposite. All these folks move suburban looking for single family to purchase. The pandemic caught the single family developers by surprise. They have low inventory, tough to find land. They can't deliver in time. So we have a real short squeeze on single family. Thus, the apartments in suburban Austin, occupancies went up, rents have gone up. Most of the trades in fourth quarter Austin were suburban because the economics were good for the sellers. Not many trades in the urban market because the economics were soft. And so that's kind of the playing field. Everyone expects a strong rebound in urban, and suburban is strong. Equity now wants to go suburban because those deals pencil. I think you'll see a drop in supply in the urban market because none of the deals pencil. So it's going to be interesting to see in 3 years if we meet again. What was the urban suburban switch there as far as occupancies and rental rates. But that's kind of the macro. And then I think you will see more urban deals come to market. There's plenty of suburban deals on the market right now. Cap rates are as low as I've ever seen them. And so pre-pandemic, Austin was already popular. Post-pandemic, much more popular. And interest rates took a dive, as you know. And so interest rates take a dive, cap rates take a dive. Everything's in the mid threes now.
3.5. So it's more expensive to buy in Austin, Texas than on the island of Manhattan right now, right?
Fair, but nobody wants to own on the island of Manhattan.
So deal story. I know as we were talking, you guys had a deal out. It was a fourth quarter last year, Bradfield Place. I know that deal. I mean, I didn't even take the time to go tour because I knew it was going to be insane. I think that's a good encapsulation of kind of what's going on in the suburban workforce housing right now in Austin.
Sure. So Bradford Point, 80s vintage value add just to the east of Domain Arboretum. So great location on Metric Boulevard. we were kind of just coming out of I mean, it was late summer, but we hadn't had any deals traded after a Q2 and Q3 of nothing happening. Yeah. This was one of the first deals out of the chute. And the owner said no tours until the best and final round. So this was a litmus test, if you will. Boy, we had 48 offers.
What was your price range guidance you were giving everybody?
I'm either an idiot or a genius. We thought that a 4 cap would be a low cap rate, $28 million. The pricing took off, ended up near $33 million and about a 2.75% T3 cap rate. The buyers would tell you they weren't concerned about a T3 cap rate. They were looking at the business plan, the price per pound, the work they could do to enhance the rents and therefore drive to a low teens IRR. So that was their thought process. But at the end of the day, the interest was insane, and it was, I'd say, 60% of the bid list, we had never heard of them. And they were coming from, East and West Coast.
So you sold an 80s deal. What was that roughly per door that thing went off at?
About $125,000 per unit.
And you thought it would be a little bit over 100 a door, 105 a door, or something like that?
Yes.
That's crazy. So 48 offers, and you probably had the top, 3, 4, 5 slugging it out at the end?
That's right. And so the part I was joking about was some people think that we purposely guided a low number so it would be competitive.
Yeah.
That's not the case. We just got surprised by the market. But what happened was 19 people go to invest in final round. And as you know, that's too many.
Yeah.
And so we eventually, due to price escalations, got down to 3 people. And, hard money at execution.
Sure.
As well as the highest price ended up winning the day.
And that was someone you never had heard of before, this whole process?
So the number 2 bidder we had never heard of before. The number 1 bidder was a local buyer that just outlasted the crowd.
Yeah.
And generally understood the real estate and wanted to own the real estate. But the number 2 bidder, private investor out of California, great buyer that we've become to know. Previous to that, they hadn't bought in Austin, so they were new to us.
Yeah, and so is that what's going on in the marketplace? You have kind of the same guys that have been around for a while, and then now we're having new people come in from the coast that you hadn't heard, kind of fleeing the higher regulated, higher price markets, and then maybe people are here up here. A lot of groups that focus on hospitality or retail or office. They now want an allocation for commercial real estate, but they can't invest in those because their investment committees won't approve it. So now they're flooding more capital in multifamily. Is that kind of what you're seeing?
Yeah, so it's interesting. We are getting calls from investors from the East and West Coast, and they're telling us, I can't invest in hospitality, retail, and office. I can't invest in the East and West Coast because of rent restrictions that we don't quite understand or were recently passed, a political environment that is uncertain, non-payment is basically acceptable, and so therefore they're coming to cities like Austin, Denver, Nashville, Raleigh, Charlotte. We get a lot of common investors in those cities, and they're following tech jobs, millennials, and just looking at the in-migration. So Austin is one of the fastest growing cities in America, and it ranks in the top 5 of every survey. And so those folks are coming and calling and saying, I don't own in Austin today, but I do understand a 3.5 cap because we're used to low cap rates.
Yeah.
And we want to own in one of these fast growing cities. And we heard about the Tesla announcement. We heard about the Apple announcement. And so it's a new breed of investors. The usual suspects haven't gone anywhere. It's just they're bitching about the new guys.
People in the best of funnel. Yeah, I'm sure I'd be frustrated too if I was in the mix. What's your Pat Jones's opinion right now of kind of like the best part of the marketplace? So if everyone's zigging, where do I zag? Where's the relative value as you see right now between Austin, San Antonio? Or within Austin specifically, types of product and, something that you could buy you think are relative value?
Sure. So I'll start with Austin. I'm seeing, tons of activity in the suburban markets, and that is a strong suburban market. So a lot of investment sales at record pricing, record low cap rates. Also, tons of development coming and equity that's fueling that development because everything pencils.
Yep.
I'm seeing the opposite in the urban market. Soft, construction is almost impossible to pencil. And so, after watching this market for years, I would be doing everything I can to buy in the urban market while it's soft. Why isn't everyone doing that? There's not many sellers, and the deals don't underwrite.
Yeah.
But I think if you could get a strong price per pound, even though it's going to underwrite to a 2 cap, you're underwriting soft fundamentals. Mm-hmm. You're underwriting 2 months of concession, and so I'd put forth the idea that it's not a real cap rate because we had such a visceral reaction to COVID, and so I think that would be a great plan if you can find something to buy, because I think you'll be rewarded over time. Over in San Antonio, I haven't seen the cap rate differential with Austin this high, and so we're 50 to 75 basis points for similar product. I also think deliveries are going to slow and are slowing in San Antonio. So you've got improving fundamentals. It's a great market. It's solid, steady Eddie. And but I think what you're going to see is increased rent growth kind of the next 3 years because supply is going to slow down. And as you know, you can't just throw up an apartment community.
Sure.
It's in the pipe for like 3 years before it delivers.
So if I'm coming in from out of town, Pat Jones's advices, go find a good price per pound kind of urban deal if you want to be in Austin. Don't chase as much suburban, and or go an hour and a half south to San Antonio and ride that out for a few years. That'd be kind of, if you're putting your money at risk, that's what you would do.
I would. I like that plan. And not to counter myself, but we recently sold a property called Broadstone 8100 that's across the street from the new Apple campus.
Yep.
I would absolutely invest in that. I mean, there's just 130-acre campuses coming across the street. So I think there's going to be some unique suburban opportunities that I would jump on.
So what's so besides kind of like the price and terms, how does like someone that's new into your market, because you get this all the time, how do they get your attention? How could someone work with you a little bit better to kind of strategize? Because it seems like when you're coming into the new market, that you don't know who you are. It's going to be challenging to get a deal in a normal environment. The first go around, you got to kind of fail a few times before you can succeed. And then that seems like what you just told me, that's on steroids right now. So that's got to be extremely frustrating if I'm coming out of town. You have a tip or trick on how to kind of work with you a little bit better to kind of crack that code?
Sure. I think I can speak for a lot of brokers that our job is to, when we're representing a seller, is to qualify. And it's not meant to be offensive. And so I get so many calls from the East and West Coast where they're offended when we ask invasive questions. We want to know where the equity is. We want to see it. We want to touch it. We want to feel it, because the seller, just sanctity of close is really important. What we're seeing is, even though pricing's aggressive, everyone knows pricing's aggressive, and we're getting 5 people at the same price.
Right.
And so if you are new to the market, I absolutely think you need to be prepared with a company description, references, and equity source. And be ready to tell the broker that first, because it's so refreshing if the broker can go to the seller like, God, this investor is so organized. Everything's right here for you to see. They'd be a great pick. I can't tell you how many offer summaries we have with 10 investors we've never heard of, and they've given us nothing other than look at my website.
Right.
And they're bravado. So we're not trying to offend anyone. We're just trying to give the seller enough information to make the best choice.
Do you have any, as we're kind of mid first quarter right now as we record this, do you have any deals out on the market right now, or what do you have coming up? What's the flavor? Sure. Maybe 1 or 2 deals, and kind of talk about that so viewers can kind of get a sense of what the opportunity is in Austin right now.
Sure. Fortunately, we had a robust fourth quarter across America in multifamily. Same in Central Texas. So as we roll into the first quarter, everyone's continuing that activity. So there's going to be quite a bit of investment sales activity. So I'll give you a kind of 2 different, totally different investments. Sona is an 80s vintage value add deal in Northwest Austin. It's the kind of deal that's going to trade for like $155,000 a door, $25 million in size.
What was the vintage again? I'm sorry.
1985.
85. Okay.
And it's tired. Everyone looking at it, everyone looking at it's going to do value add.
Sure.
And you can walk in the units and say, wow, this lends itself nicely to value add. And you're the low rent, workforce housing provider in the area. So from that standpoint, there's a lot of room to grow the rents. And this will be all private investors chasing it. It will be a very low cap rate. And the top bidders are not going to be real concerned about a T3 cap rate. They're going to be looking at the totality of their business plan and where they can push rents.
Sure.
Kind of complete other end of the spectrum, we're launching next week the Elizabeth. It was built by Streetlights Residential. Goldman Sachs is the equity. It's a beautiful mid-rise at the Lakeline Metro Rail Station.
Northwest Austin.
This will be Northwest Austin,
Yeah.
Cedar Park.
Yep.
Excellent schools, excellent demographics, down the street from the Lakeline Mall, not far from the Apple campus. Mid-rise, super sexy product, 5 elevators, and that's going to be, a core A+ opportunity, and that's going to be chased by institutional investors and private family offices, private funds, and those folks will be looking to clip a coupon and hold it for years.
And what's the approximate pricing of that out per door?
That would be more like a $285,000 per unit type of opportunity.
So kind of 25 minutes with no traffic to downtown, high-end core plus product, $280-$285 a unit. That's kind of today's pricing and that's probably best-in-class product. That's not your garden variety generic wrap, because Streetlights builds a really good product.
Right.
So if that was a good garden variety generic wrap in that location, you're probably $240-$250 a door?
Yeah, so first, it's near the Metro Rail Station, so you could take the rail to downtown. However, I think a lot of these folks work in tech along, Palmer Lane's a major tech corridor with eBay, PayPal, Apple, Samsung. And so most of these folks are going to work north, and it's a lifestyle choice to live here. You could easily go find lower rents in a 3-story stick community, but this has, knocked out amenity centers. It's really fancy and appeals to young professionals in the tech world, and or a slightly older demographic, someone that wants to be there because of the schools. So it is, an A+ opportunity.
Do you have anything out in San Antonio or anything coming up in San Antonio in the near future?
Yes. So in San Antonio, we're just on the market with a property called Preston Peak, 596 units in the South Texas Medical Center. So excellent location with proximity to all the hospitals. The USAA campus is about 2 miles to our north.
Yeah.
And that's going to be something like an $80 million size transaction. But the price per pound is going to feel really good, about $130,000 a door. It was built in 1995. It is for sure a value add opportunity. And then we're bringing a core deal called Southtown Flats, which is in urban San Antonio in Southtown, which is a very hip, cool area. That is 2 to 3 weeks that will come on the market.
Yeah. And what approximate pricing per door does that look like down there?
That is going to be right around $200 per unit.
Okay. And that's a wrap. You said wrap product.
It is
urban core.
Mid-rise urban core structured parking wrap product.
And if that was in Austin, that'd be $280,000 to $300,000.
That's right. That's right. Yeah. If you picked it up and put it in Austin, $300 a door.
Yeah. Pat, so, you and I have both been very fortunate to be, have some success in this business and this industry. If you're talking to somebody, maybe one of your kids in a few years that are looking in the industry, do you have any advice for someone that might try to crack into our business and some of the things that were successful for you? Because like I said, you kind of meandered a little bit before you got here, and most people come right out of college and work for a brokerage shop or private equity firm, or I did the bank, and kind of transition yourself over.
Yeah, I think, and we get called a lot by young folks graduating, and I always tell them, look, start at a bank, a private equity firm, a brokerage shop, and be a financial analyst so you learn the ropes, a development firm, and go learn the construction side of it. In all cases, If you're young, eager, aggressive, start in those firms, get a base knowledge of experience, you can go anywhere.
Yeah.
And so I would not set my heart on just, I got to be in this sector of real estate. Once you start in real estate, you're going to meet all these people. Our business is still relationships and networking. And you will always know someone in real estate. And if you make 20 connections, that's going to lead you somewhere. And so I think that also if you're just focusing on brokerage, starting as a financial analyst is critical because you learn how to underwrite the income and expense of an apartment community, which then gives you the education level to go talk to owners like Michael Becker and underwrite the cash flow and value of the property. So I that background, that financial analysis background is absolutely necessary.
Yeah, I think it's good advice. And, the way I came, I think it was a little bit harder because bankers tend to be extremely conservative. So to kind of break that mold and take risk. And when you call me and say, hey, I got a sexy deal, but it's a super low cap rate, like you call me all the time. Seems like every conversation that we talk about has that start to it. It's a sexy deal, but the cap rate's low. That's kind of at least the last couple of years. But anyway, so I feel real fortunate. I've done a couple transactions with Pat. Hopefully get another one or two maybe on the school board in 2021 with Pat in Austin, and maybe hopefully crack into San Antonio. So if anyone's interested in going to Austin or San Antonio, Pat and his team at Newmark are certainly among the leaders in that marketplace in our industry, and I certainly encourage people to reach out to you guys. Pat, if people want to know more about you guys, reach out to you, what's the best resource to contact you guys?
Sure. You can just go, Newmark's publicly traded, and it's ngkf.com, but you can just Google Newmark, Pat Jones or Patton Jones, and it'll pop right up. Yeah, and you'll get all the contact info.
Perfect. So if anyone's interested, definitely appreciate you. Definitely suggest and recommend that you guys reach out to Pat or any of his members on his team. They do a great job. Really enjoyed our relationship, Pat, and working with you, and hopefully get a few more on the scoreboard. So for Pat Jones, I'm Michael Becker. Appreciate it. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.